All right, well, welcome to chapter 14, where we talk about some incremental analysis. It's looking at if you add or take away something, will it add value to your organization? So this chapter looks at a few different learning outcomes expected, talks about management's decision-making process, looks at relevant costs that you should include, whether you want to accept an order at special prices, looking at make or buy decisions, determining whether you should sell or process materials any further, whether you should look at, what are relevant costs and when you're considering repair, retaining, or replacing equipment. And so it's all really about incremental components. The last item is about unprofitable segments. So do you have an operating line that maybe is actually hurting your business overall? So we'll look at that as well. So the first section then is we'll look at management's decisions surrounding making process and incremental analysis. So when they make decisions, you always want to make sure that management, you're not just following a set pattern, because obviously you have to look at the situation independently. Every decision that you look at might have a different, sense of urgency, certain level of importance in how it supports your strategy as an organization, or different scope. Typically, when you're looking at making these decisions, you want to look, what is the problem, who's responsible, what are possible courses of action. Once you've looked at those different courses of action, you'll make a decision and review any results, and hopefully you can support the decision that you've made. When businesses are making those decisions, they look not only at financial, but also at non-financial. So statistically, what's the impact on the organization? Financial, we've been covering a lot in the past, looks at revenue and expenses specifically. And it also financially looks at overall profitability. Non-financial might be, the decision maybe was a poor one, your employee turnover increases or improves. The environment, what's the impact on the environment around you? And what's the company image? Decisions typically, look at alternative courses of action for a specific situation. And you'll analyze the data based on both quantitative or financial and qualitative decisions. You'll look at alternative courses of action that costs and revenues might be different in each course. Sometimes only revenues will vary and your costs will be all the same, or vice versa. Your revenues might be the same, but only your costs may vary. So a little visual example here, we have alternative A and B and what the differences are. So we can only do A or B. Which one would be better? So under A and B, revenues would be $15,000 less under alternative B compared to A. So you think, I'm making less money. However, our cost would be $20,000 less under alternative B. So therefore, our net income, if we chose alternative B, would actually improve by $5,000. So if you only look at revenues, you'd be actually making the wrong decision, because your bottom line, if your goal is just to make more money, more net income, alternative B would be a better end state. So some of the cost concepts that you'll have to keep in mind for this entire chapter, you want to look at relevant costs. So costs and revenues differ across alternatives. You want to always keep that in mind. What are the differences? Opportunity costs. So what's the potential benefits if other alternatives are not selected? And we'll walk through some examples. And sunk costs are costs that are incurred no matter what. So it doesn't matter what decision you're going to make, you've already paid it. An example of that most commonly is about capital equipment. If you have a truck and decision A uses the truck, decision B does not, but you can't sell the truck is a sunk cost because you're going to have it no matter what you do. Other things to consider is sometimes it involves changes that might be, opposite or contrary to your intuition. So your intuition might say, oh, I should choose alternative A, but after going through the incremental analysis, you might actually choose alternative B. And that's why it's important to go through this process and actually documenting the pros and cons or the income and expenses of various alternatives. Variable costs do not always change under alternatives, so keep an eye on that. And fixed costs sometimes change. So even though you have a fixed cost, you might have something that would be different under a specific situation. Maybe you need more management support on one side. Maybe you need more office space on one side or the other, et cetera. Common types of decisions, do you want to, I think we covered a little bit of this at the beginning. Do you want to accept an order at a special price? Do you want to make or buy? Do you want to sell a product or process them further? Do you want to repair, retain, or replace equipment? Or do you want to eliminate an unprofitable business segment or product? So a little review question then. Incremental analysis is the process of identifying the financial data that what? Does not change under alternative courses of action, changes under alternative course of action, are mixed under alternative course of action, or none of the above. Incremental analysis talks about the changes. So it's the differences under different courses of action that you can take as an entity. So we're going to look at a situation about this company, ONT Corporation, and they have two different operations here. The company currently operates under option 1, revenues of 80,000, maintenance of 5, operating expenses of 38. Option 2 provides revenues of 80, maintenance expenses of 12, operating expenses of 32. Option 1 employs a piece of equipment that was upgraded 2 years ago at a cost of 22,000. If option 2 is chosen, it'll free up resources that will increase revenues by 3,000. So we want to complete a table showing the change in income from option 2 versus option 1, and we're asked to designate any sunk costs with an S. So we've got this little table set up here under option 1, option 2. Is it an impact on the net income? And is it sunk? So we'll look at revenues, expenses, both maintenance and operating, our equipment upgrade that we talked about, and our opportunity costs. In both scenarios, we have revenues of $80,000. There's no impact to net income because the revenues are the same in both situations. Looking at maintenance expenses, option 2 costs us more. So therefore, it's a decrease compared to option 1 of 7,000. Operating expenses, 38 and 32, it's a increase to net income of 6,000. So far, it's a decrease of 1,000. The equipment upgrade, option 1, costs us 22,000. Option 2 really has no impact, but the difference of 22,000 doesn't really matter. We already paid for the equipment. It's already in our possession. It's considered a sunk cost. It does not come into play. However, we're told there are opportunity costs that if we don't do option 2, then it's going to cost, we're going to miss out on $3,000. So we need to add that as a net income increase if we were to select option 2. So overall, we have a net income increase under option 2 compared to option 1 of $2,000. Next little category we'll talk about today is about analyzing the relevant costs and accepting orders at special rates. So sometimes you may get a request from a customer to make a product or sell a product at a different price than normal. Sometimes you may or may not want to produce that, or may not want to accept that price. And one of the assumptions is that what if the company is not operating at full capacity? So you have capacity to actually meet the order. So let's go through an example. Sunbelt Company produces 100,000 smoothie per month, which is 80% of plant capacity. So we know there's room to make more. Variable manufacturing costs are $8 per unit. Fixed are $400 or $4 per unit. The smoothie blenders are normally sold to retailers for $20, and we have an offer from a wholesaler to buy 2,000 at $11. Acceptance of the offer would not affect normal sales of the product, and the additional units can be manufactured without increasing plant capacity. So first you might say, oh, 11 compared to 20, maybe I shouldn't do it, but let's go through the process. If I were to reject the order, I get no more revenue. If I accept the order, I get 2,000 times the $11 in my pocket, 22,000. Under the cost, if I go back for a minute, our variable manufacturing costs are $8 per unit. Our fixed, we're going to pay anyway. So our fixed are already paid for. So we only need to worry about our variable manufacturing costs. So $8 a unit times 2,000 units gives us $16,000 in costs if we accept the order. So therefore, our net income would actually increase by $6,000. And that's all because fixed costs do not change. If we don't take the order, we're still going to pay them. So we should accept this special order from Sunbelt because it increases net income by $6,000. Let's do another example. Cobb Company incurs costs of $28 per unit, 18 variable, 10 fixed, to make a product that normally sells for $42. A foreign wholesaler offers to buy 5,000 units at $25 each. A special order results in additional shipping costs of $1 per unit. And we're asked to compute whether there's an increase or decrease in net income. So if they were to reject the order, nothing except the order would be $125,000. That's 5,000 units at $25 each. The cost would be the 5,000 units times the variable cost only of $18 plus the dollar each to ship. So our total cost would be $95,000. Therefore, our net income would also increase in this situation by a net of $30,000. We should accept this order. Next, we want to look at the relevant costs in a make or buy decision. We have Barron Company, they incur the following annual costs in producing 25,000 ignition switches for scooters with direct materials, labor, variable overhead, fixed overhead, for a total manufacturing cost of $225,000, which is a cost per unit of $9. Barron can purchase the switches at $8 per unit and save $10,000 in fixed overheads. What should we do? So if we were to make, we have direct material costs of $50, labor, down the list, we have $225,000 to make the items. That does not change. Under the buy side, we were told, obviously, our direct materials, labors, and variable manufacturing would drop to $0. Our fixed manufacturing would drop by $10,000. And our purchase price would be a new item, $8 times 25, give us a purchase price of $200. In this situation, it would actually cost us $25,000 more to buy the items than it would be to continue to make them. Therefore, the recommendation in these assumptions would be that Barron should continue making the switches. Now, looking at opportunity costs. Opportunity cost talks about what was or what is the lost potential benefit that could be or could have been obtained from following an alternative course of action. When we're looking at making or buy, it's important for management to take into account the social impact on the choice. Are we going to lose jobs? How's it going to affect the morale of employees? So in this illustration, talking about Barron making the switches or purchasing them, the released product capacity to generate additional income of $38,000 from producing a different product. So if they do make the item, if they do buy the items, they could possibly generate other income from another line. So that lost income is an additional cost of making the items, because if they make them inside, they can't make that money. But if they buy them, they could make that money. If we add this assumption in place, it would actually improve their net income by $13,000 bottom line. So in this situation, they should buy the switches and use that opportunity to generate the additional income from a different product. Little review question, and make or buy decision. Relevant costs are manufacturing costs to be saved, the purchase price of the units, opportunity costs are all the above. You just walk through it, and it's all of those items. Okay, we got another example. Juanita Company must decide whether to make or buy some of its components for its produced appliances. The cost of producing 166,000 cords for its appliances are as follows: direct materials, labor, variable, and fixed overhead as on screen. Instead of making the electrical cords at an average cost of $1, the company has an opportunity to buy the cords at 90 cents. If the company purchased the cord, all variable costs and 1/4 of the fixed costs will be eliminated. In this case, if we make, let's scroll down here. So if we make the items, we'll spend 166,000 as always. And if we buy the items, our fixed manufacturing costs will drop by 25%. So that drops it to 18. And then our purchase price would be 90 cents times the 166,000 units for a total spend of 149.4. In this situation, they would actually decrease their net income by 1,400. So assuming no other variables, they should continue making the electrical cords. Now, what if the released productive capacity would generate an additional income of $5,000? That becomes an opportunity cost of the make situation. So therefore, the net income increase, including the released productive capacity, would be an income of $3,600. So now in this situation, they should purchase those electrical cables. Next, we're talking about analyzing the relevant costs and revenues and determining whether to sell or process materials further. So when you're in production, very often you'll take raw materials, you'll make something to make something else. So the idea is, at what point do you sell the products that you've produced? So what we want to do is look at incremental revenue between phases. That's what it comes down to. So let's look at this company. They make tables. The cost to manufacture an unfinished table is $35. The selling price per unfinished unit is 50, and we have unused capacity that can be used to finish the tables and sell them at 60. For a finished table, direct materials will increase by 2 and direct labor will increase by 4. Variable manufacturing overhead costs will increase by 240, 60% of direct labor, and no increase is anticipated in fixed manufacturing overhead. So a little schedule here that talks about the manufacturing costs, different components, and we'll pull that into the next chart. So if we look at our incremental analysis, we have our sales price per unit under sell unfinished or process further. Our direct materials we're told would go up by 2, direct labor would go up by 4, variable manufacturing overhead by 240. So our net income per unit would go from 15 to 16.60, which means a net income increase of $1.60. So in this case, they should process further. They have incremental income. Now, what if you have multiple products? So for an example, what if you have cream and skim milk? They're joint products that result from the processing of raw milk. So joint product costs are considered sunk costs, and that's not relevant to the sell or process further decision. So I need to see these common process costs. They're considered joint costs. So the joint cost allocated to cream would be, say, 9,000. The cost to process the cream and the cottage cheese, 10. Revenue from the products per day, say cream is 19,000 and cottage cheese is 27,000. So if we have whether to sell cream or process further, sales per day, if we just sold it, would be 19,000. Okay, so sales from cream versus if we process further would be 27,000 in revenue. But the cost to process cream and the cottage cheese would be an additional 10,000. So therefore, our net income would actually decrease by $2,000 if we process further. We should not. What about for the skim milk side? Joint costs allocated to skim milk, applied based on production volume. Cost to process skim milk to condensed milk, skim milk revenue versus condensed milk revenue. 11 to 26. The cost to process further 8,000. Therefore, our net income is actually a decrease of 7,000. So we should not process our cream any further than the original step. So next we talk about, should we process further as long as the incremental revenue from processing exceeds incremental processing costs, variable processing costs, fixed processing costs, or no correct answer is given. And in this case, we're looking at incremental revenue where it exceeds incremental processing costs. Next is we have this company who manufactures unpainted furniture for the do-it-yourself market. We currently sell a rocking chair for 25 bucks and production costs are 12 variable, 8 fixed. We're considering painting the chair and selling it for 35. Variable costs to paint each chair are 9 bucks and fixed costs are expected to be 2 bucks. Should we sell them unpainted or painted? Our revenue is under a sell situation. Unpainted would be 25, process further 35. Variable costs increased from 12 to 21. Fixed costs from 8 to 10. So our net income per unit actually drops from 5 to 4. Therefore, we should sell them unpainted. Next learning objective is looking at analyzing the relevant costs to be considered when repairing, retaining, or replacing equipment. So again, company has a factory machine that originally cost $110,000. It has a balance and accumulated depreciation of 70, so therefore the book value is 40. Useful life of 4 years. We're debating whether to replace this with a new machine. The new machine would cost 120. It is expected to have 0 salvage value at the end of its 4-year useful life. If the new machine is acquired, variable manufacturing costs are expected to decrease from 160 to 125, and the only unit could be sold for $5,000. So our variable manufacturing cost, if we keep the equipment, it would be 4 years at 160 versus replacing equipment would be 4 years at 125. Our new machine costs, nothing if we keep the current one, 120 if we replace it. Sale of the old machine would generate $5,000. In this situation, our net income would increase by $25,000. So therefore, we should replace the equipment. All right, so the book value of the old machine does not affect the decision because the book value is a sunk cost. The cost which cannot be changed by future decisions. Therefore, it does not come into play in incremental analysis. However, any trade-in value or cash disposal value is relevant because you wouldn't have that otherwise. The roofing company is faced with a decision, and we use a 60-foot extension lift for work on large homes. Last year, we spent $60,000 refurbishing. Another $40,000 of repair work is required. We found a newer lift for sale for $170. We think that both the old and new lifts would have a useful life of 6 years. However, the new lift is more efficient and thus would reduce operating expenses to $20. We could rent it for $2. The old lift is not suitable for rental. The old lift could currently be sold for $25. Same process, our operating expenses if we keep it. That's our maintenance, repair costs, our rental revenue, new machine costs, sale of the old machine. Oh, we got no subtotals on here. So we have 120, 160, 172, less 170 plus 25. Would actually our net income increased? If I did that right, it would be 27,000 increased bottom line. So we should replace the equipment in this scenario. Moving on to learning objective 6. What are the relevant costs in deciding whether to eliminate an unprofitable segment or product? Again, we focus on relevant costs. What's the effect on related product lines? Fixed costs, don't forget, if you eliminate a line, they must be absorbed by other segments. Therefore, you don't want to include any fixed costs. Net income may decrease when an unprofitable segment is eliminated. So your decision rule needs to be retain the segment unless the fixed costs eliminated exceed the contribution margin lost. So in this example, we have a pro and a master line for Champ. We have our sales, variable costs, our contribution margin, fixed costs, and our net income. And so our total Champ net income is a loss of 220. Our Champ line has a loss of 20,000. And we're wanting to know if Champ would be helpful to be eliminated. So we want to prepare income data after eliminating Champ. Okay, so in this case, the $30,000 from Champ and fixed costs need to be absorbed. So our 160 remains. The other variable components are adjusted accordingly. So our net income under this situation would be 210 versus 220,000 originally. So income actually decreases. They should keep it. So you see our contribution margin of 10,000, our fixed cost of 30. Therefore, it has a $10,000 reduction in our contribution margin. Another way to look at do not eliminate champ. What if we assume that 22,000 of fixed costs attributed to the champ can be eliminated if the line is continued? In that case, we would have a $12,000 pickup because it would not all be a sunk cost. So one of the last few things here then, if an unprofitable segment is eliminated, what will happen? Net income will increase. Variable expenses in the eliminated segment will have to be absorbed. Fixed costs allocated will have to be absorbed. Or net income will always decrease. Well, A, B, and D are not always correct. So C is fixed expenses allocated will have to be absorbed by other segments. A little example before we wrap up. Lambert manufactures several types of accessories. We have sales of 400, variable of 310, fixed of 120. And we had a net loss of 30. And we think that 20,000 of fixed costs will remain if we eliminate the knit hats and scarves line. So if we continue, we'll have sales, we'll have variable costs, we'll have fixed costs. But if we eliminate it, we'll save some. So far, our net income would increase by $10,000. So we should eliminate the line. And that's the chapter. Take care.